Alright, welcome back to another edition of Intermediate Accounting 1. We're going to continue on with Chapter 6 here, so let's see here. Chapter 6, we're only going to look at 6.2, 3, 4, and 5. You can go ahead and skip 6.1. I'm not going to test you again on the bank reconciliation. You went through enough torture on that through Financial Accounting 2300. Cash controls, that's also recommended. You don't have to read it. And the collectability assessment, optional. Just focus on 6.2, 3, 4, and 5. There's plenty of dense material in there. So when we're talking about receivables, what do we really mean? We're talking about claims held against customers. Now, claims held against customers can mean a couple different things, but in general, what it means is we have a legal claim to collect cash for what? For basically goods and services that were already given to the customer. Okay, so when we give stuff to a customer, usually we expect payment within 30 days. Generally speaking, those types of receivables are accounts receivables classified as current, but you can also have some non-current receivables, but those are usually notes receivable. Trade versus non-trade. Trade receivables, when we sell shoes on account, when we perform services on account, that's a trade. A non-trade would be like, hey, we lend out money to an employee or something like that. It's non-trade. Accounts versus notes. There's a big difference between those. We'll talk about those. So non-trade receivables, if we do lend money to employees, you don't really see it too often. So don't think this is a very common situation. But I've seen it maybe only on one client ever in my entire career. It's more common to see corporations that own other companies, which we call subsidiaries. It's common for those corporations to lend money to those subsidiaries just as a formality to make sure that those standalone companies, they recognize that they have a note payable and the corporation recognizes that they are due that money back in the form of a note receivable. There are also some other reasons too why we might see receivables, but the most common thing you just need to realize is you got accounts receivable, you got notes receivable, and among those two types of receivables, accounts receivable is the more common type. Molson Coors numbers are stated in thousands, which means we have to add 3 zeros to the end of each of these numbers here. You see there are accounts and notes receivable that are current, not $758,000, $758 million. Okay, and of course that's going to be net of less of the allowance for bad debts, the allowance for doubtful accounts. When you look at accounts receivable, realize that it's a customer that we have already been doing business with for a long time. We already have an arrangement with this person. We know who they are. We've done the background check. It's not like we're going to extend credit to somebody just who comes in and says, I'll pay you back later, bro. These arrangements are made with people. And so when you think about these numbers, these accounts receivable, remember that these numbers represent people. They represent relationships. We have an arrangement with this person. We'll establish credit terms that are based on our history working with this person. They usually do cash and carry or use their credit card. Now we're actually just going to say, you know what? When you need something, call, send a purchase order, we'll send it to you, and then we'll bill you later. Okay? You know that phrase sell on account or any type of sales on account means that we've earned the revenue, but we didn't collect the cash yet. So the debit in this case is going to be to accounts receivable, unless I tell you otherwise. As an example, and this kind of like gives us a heads up about chapter 7 and 8. We do have to worry about accruing for the account receivable or the accounts receivable and the sales revenue. So in this case, the price of the goods is 100. Chapter 7 and 8, we start talking about the corresponding cost of goods sold. If we do make a sale on account, sales revenue is what we record. It means that we gave goods, we gave t-shirts, we sold pizza, something tangible, something that was in inventory and now is gone. We record sales revenue, but we have to follow that up with the debit to cost of goods sold and a credit to inventory. Generally speaking, you're given information about the price and the cost in these problems I give you. Just realize that the price is going to be higher than the cost. I'm not going to mess around with that. How do you know, this kind of harkens back to chapter 17, how do you know when the customer owes us money? Well, they've collected the goods or they've recognized the benefit of the service. They have some sort of they're enhanced better by whatever we provided them. The value we gave, they recognize it, which means that we now have legal right to collect that money. If they're goods, usually it means that they have collected physical possession. But just remember, too, that I'm not going to nitpick too much over did the customer actually get the goods. There are concerns about sales returns, but for the most part, when we ship the goods, if it's FOB shipping point, hey, those goods are now in the control of the customer. We are owed that money. The total transaction price, remember that just also as a recollection from chapter 17, that's the amount we record based on how much we expect to receive. So if we sold $100 worth of goods, we expect to collect $100 worth of goods. We'll record that. Okay? But there are things where we have to say maybe we need to adjust that revenue, total revenue down to a certain amount. Enter in the discussion of discounts, returns, and allowances. When you're looking at discounts, realize that there are a couple types that you got to watch out for. Number one thing is, and don't confuse these, okay? There's trade discounts and there's sales discounts. A trade discount is where we give the customer a discount at their cash register. They want to buy something, we immediately reduce the overall transaction price. If they buy, usually they come in, they buy 100 units, but this time they come in and buy 200 units, we immediately, out of the goodness of our heart, we immediately give them, say, a 5 or 10% discount immediately. That's a trade discount. You usually don't see that recorded anywhere. It's just a direct reduction to the price. Thanks for doing business with us. Oftentimes, you know that trade discounts are applied in practice because if you go into Amazon, you'll see that when you buy larger quantities of goods, of some type of product, you actually get a reduction in the price per unit. That's a trade discount. You don't see that recorded on the seller side. Sales discounts are different. Sales discounts are where somebody purchases on account and they're expected to pay back later. To help encourage people to pay us back, we offer these sales discounts as an incentive to pay early. If we're happy to sell you these goods, and we know that we can collect within 30 days, but if you pay us within 10 days, you can knock off 1, 2, maybe 3% of what you owe us as an incentive to, hey, don't delay, pay us right away. So we're going to use a contra revenue account in these situations. When we have customers we've done business with for years, set up an account receivable with credit terms. Sometimes those terms are set up, a common way of showing it is 210 net 30. 210 means if you pay us within 10 days, you can knock off 2% of the price that you owe us. So if we charge them, if the regular price is $100 and they pay us, we sell on account, charge them $100. If they pay us within 10 days, they only have to pay us $98. And they know this too. So they will take advantage of this as much as possible. 2% is a lot of money over time. That's what the 210 stands for. The net 30 says if you don't pay us within 10 days, pay us the net amount within 30 days. Net basically meaning that pay us the net amount, the amount you got net of any returns or allowances that we granted you. You may recall seeing this in Accounting 2300. If you don't, then you're going to want to pay close attention. There's two methodologies by which we record this information, the gross method and the net method. Okay? When you're looking at this example, we're taking a look at the gross and the net method side by side. This one says Beerbo sells goods on account, total $10,000. The credit terms are 110, net 15. Read the terms carefully. Okay, that means 1% off if the customer pays within 10 days. Otherwise, they owe us the full amount within 15 days. We're pretty quick and short to the punch. So if you're using the gross method, it says, hey, look, you sold $10,000 of goods. Just record debit accounts receivable, $10,000, credit sales revenue, $10,000. The net method says, assume that the customer will go ahead and pay us within those 10 days. If it's the day one and we just sold them the goods, some people have a hard time believing this, but you know what? If 99% of the time, the customer pays us within 10 days, let's just go ahead and record it at 100% minus that 1%. In other words, let's record not the full $10,000 that they owe us. Let's record what we expect to collect. We expect to collect $9,900, so therefore record that. That's the net method. FASB prefers this because it ultimately results in lower sales revenue. We don't want to overstate our revenue on the income statement. I'm not a big fan of the net method, but you got to know both. So here's the setup. We sell some goods to Budweiser, not Hanley Company. Beerbo sells goods for $10,000 to Hanley. Sorry, cross that out. Change that, if you will, please. And the terms in this case are 210 net 30. I hate to jump around with the terms, but you kind of get the idea here that when you're reading the terms carefully, they may jump around. Ordinarily, 210 net 30 is a common type of credit terms we offer. We are Hanley. Sorry for this error here. Change Hanley to Beerbo. We receive payment of 3920 from Budweiser. Change Murdoch to Budweiser. Related to 40% of the sales. So we collected cash. It's related to 40% of the sales on the account. We received the other $6,000 on March 1st. What's going on here? Let's walk through this through journal entries here. Here's the story. Okay, dear diary, we sold some goods on March 1st. Okay, under the gross method, we'll record the full amount they owe us. This makes sense from my perspective. Okay, they owe us legally $10,000. I don't know if they're going to take advantage of the 210 net 30. Let's just see what happens. Within the 10 days on March 8th, they paid us 3920 cash. That was part of the information. The other information said, hey, that 3920 represented 40% of what was owed, which is the $10,000, 40% times 10,000. So we were going to reduce accounts receivable. It went in at 100%. We're going to pull it out at 100%. So of the 10,000 we sold on account, 4,000 was collected. But when we say collected, exactly how much in cash? Well, 3920 was collected. Why? Because the customer knows, hey, look, if I pay within 10 days, I can take 2% off of this $4,000 that I owe them. Fine. 3920 is what we collect in cash, and then at this point we recognize, hey, they took advantage of a sales discount. Fine. The sales discount is a contra revenue account. The sales revenue is $10,000. When we report this information on our income statement, we're going to net that with 80 of a sales discount to recognize the fact that the customer paid us early. Aside from that, they didn't pay us the rest of the balance till later. They don't get to take advantage of this discount, so they owe us the remaining balance, $6,000 in cash. So again, what does this represent? Debit accounts receivable $10,000, collected some of it, 40% of it, within 10 days. So credit accounts receivable $4,000, and then we received the remaining portion within the 30-day period, $6,000. So it went in at 100%, it comes out at 100%. Contrast that with the net method. Net method says don't put it in at 100%, put it in at 98%. If we expect to collect 98% of the sale, meaning that we know the customer usually takes advantage of this sales discount, then let's just go ahead and record it at 9,800. Why bother recording that full 10,000? We expect to collect 9,800. Let's record it at 9,800. Fair enough. What cash did we get on March 8th? 3920, which represented 40% of what they owe us. What's 40%? Accounts receivable, we're crediting 3920. Why is that? This 3920 represents 40% of $9,800. That's what we put in. We put in at the discounted rate, 98%. We pull out at the discounted rate, 98%. Fine, they took advantage of the discount. We don't have to do an extra journal entry. Cool. What about the remaining portion? This is kind of weird, okay? If we get the remaining portion of what they owe us, $6,000, realize we still have to pull out 5880 from accounts receivable. Because why? Because it went in at 98%. It must be pulled out at 98%. But they paid us $6,000. So where's the other 120 go to? Well, we call it sales discount forfeited. You can treat it just as other revenue on the income statement. Usually you don't see this type of scenario. I'm not a big fan of the net method because it assumes that the customer is going to pay us. They're going to take advantage of the discount. Here, they took some advantage of the discount, but when they were a little lazy, they had to pay us the full amount at 100%. Speaking of returns and allowances, the sales returns and allowances is also a contra account. Sales discount, contra account. Sales returns and allowances, contra account. We need to keep track of these things in the business because managers want to know, hey, look, If I've got to offer sales discounts, I want to know through its own contra account how much the customer is actually taking advantage of. If I actually allow customers to return defective goods, I need a separate contra revenue account to keep track of those things. So this is done. It may seem kind of tedious to have these contra revenue accounts, but realize we're trying to do a better job of keeping track of the little unique sort of idiosyncrasies of the business. Sometimes there are defective goods, sometimes there are returns. We want to keep track of that so it's easily identifiable. Maybe we have a problem with defective goods, who knows? Generally speaking, sales returns, those happen when the customer identifies that some of the goods we shipped them are defective. Fine. What do they do when they tell us some of the goods we sent them are crap? Well, here's what we do. We can allow them to return the goods, or we can allow them to just keep the goods, throw away the goods, do whatever they want with the goods. But either way, when we are notified that some of the goods are defective, we need to reduce accounts receivable some way. We don't want to charge people for defective goods. Sales returns and allowances just keeps track of specifically any type of defective goods. Beerbo sells 100 units at $100 each. That's $100 is the price per each. On account of Miller Lite, total revenue is $10,000. That's the total transaction price. The cost of each unit is $60. So 60 times 100, that's the cost of goods sold. We allow the customer to return any defective units within 45 days. We estimate 3 units will be returned. On the 24th, 2 units are actually returned. At the end of the month, assume that's the end of the fiscal year, 1 more unit needs to be returned. Cool. Here's how it goes. Dear Diary, we sold $10,000 worth of goods, 100 units times $100. That's the price. That's the total transaction price, $10,000. Assume we're using the gross method unless I tell you otherwise. Don't worry about sales discounts right now. This is about returns. When we record the sale, we also have to record the cost of goods sold. We sold 100 units. We presume all those units are good. $60 is the cost on our side. So we'll go ahead and record $6,000. That's a $4,000 gross profit. Not too bad. Now, we find out on the 24th that 2 of the units are bad, are defective. 2 things we got to do. Number 1, we got to reduce accounts receivable. We're not going to charge our customers $200 for bad goods. So we'll reduce accounts receivable, but we're going to debit not the sales revenue. Leave sales revenue alone. That's the gross sales. Keep track of any returns through sales returns and allowances. That's the contra revenue account. That way we can sort of go back over time and see, hey, are we selling defective goods? How much in returns did we have this year or this month? The sales returns and allowances account helps us keep track of that easily. 2 units were returned. That will be the debit. That 200 will offset the sales revenue credit of 10,000. But we're not done yet. Yes, we acknowledge to the customer, you don't have to pay us on those 2 units, okay? We'll reduce your accounts receivable. Usually we issue what's called a credit memo. We also have to follow this up. When we get the goods, we don't necessarily want to put the inventory right back with all the other inventory. We probably want to put this in quarantine. So this inventory returned account is like regular inventory, but it's a special account to sort of say, we need to follow up on this. Let's do some testing on these units to make sure that they're working okay. Maybe the customer just didn't know how to turn it on, or maybe the batteries were bad, or who knows. But it is inventory. We include this inventory T account with other inventory T accounts when we produce the balance sheet. This inventory return account says, go follow up with these. These are located in quarantine someplace. We need to test that. We will reduce cost of goods sold when the goods are returned. Now, here's where it gets kind of weird, and people get confused by this. If it's at the end of the reporting period, in this case, we'll assume January 31st is the end of our fiscal year, we have to ask ourselves, number 1, are there any goods out there that are still potentially capable of being returned to us? In this scenario, we assume that at the end of this year, there's still potentially 1 more unit that might be returned. It might be returned to us. In this case, we'll go ahead and debit sales returns and allowances for that amount we expect to be returned. We're not going to credit we're not going to credit the accounts receivable. We're going to credit a liability account called refund liability. The reason why here is because this potential return hasn't happened yet. So we don't want to reduce accounts receivable for our customer. They haven't told us whether or not this extra unit is defective. We're just guessing that maybe it might be defective. Accounts receivable is left alone in this situation. We do acknowledge that there's going to be some inventory maybe returns. This inventory estimated returns is also included with all of our other inventory accounts. We'll debit that account and we'll credit cost of goods sold. This is kind of weird because, again, this one unit has not been returned to us. It hasn't even been identified. We're just making a guess, an estimate of whether of potentially one more unit coming back to us. The FASB requires that, yes, we record actual returns to us, but we also record something for any anticipated expected future returns. It seems weird. Just make sure you know the journal entries. Practice writing those down. By the way, when we talk about accounts receivable, there is a time lag between when we make the sale, i.e. when we record accounts receivable, and when we collect the cash later. Maybe it's a month later. Just realize on accounts receivable, we allow our customers a 1 month grace period. We don't necessarily require them to pay us the amount plus interest. I mean, you could say, well, it's 1 month. You have a whole month not to pay us. True, that's a courtesy. A grace period is a courtesy. We want them to do business with us. We want them to shop at our store. We want to make those sales happen. We're lenient with when we collect the cash. If, however, the customer tells us they cannot pay within the standard 30 days, they need to tell us. And we need to set up a note receivable where we do charge interest. Other than that, if a customer doesn't pay us within 30 days, maybe by the time it gets to 60 days or 90 days, maybe we start charging him a late fee. Either way, just realize accounts receivable, we don't charge any interest on that. The next issue I want to talk about is one that I think requires a lot of attention, and that's the bad debt expense. We talked about this before, but I really think it's one of the more difficult topics in financial accounting for people to appreciate. Understand that when we sell on account, we take on a risk. The risk is that customers might not pay us the money later. The reward is we get to record the sale when we otherwise might not record the sale. If we were a company that just said pay us cash only, we don't sell on account, we might not have as much in sales. But the moment we say, hey, we can sell to you on account, oh yeah, we're going to see an increase in our sales because customers appreciate that flexibility. The problem, again, is that we take on the risk that they may not pay us back. And that's where I say the bad debt expense, when we record that, that represents that nagging feeling, that cost, that risk of them not paying us back. We record that when usually at the end of the year when we're making an adjusting journal entry. It doesn't represent an actual write-off. It represents the cost, the risk associated with selling on account, the risk that we might not get paid back later. Now, the question though is, should we record that bad debt expense before the bad news happens or after the bad news happens? FASB says don't wait. The direct write-off method is the less common way of dealing with bad debt expense. It's deficient. It says if you wait to record bad debt expense, you run the risk of overstating your accounts receivable. If you suspect at all somebody won't pay you back, you should use the allowance method. You should record some amount, some expectation of who or how much you might not collect. In this case, we have a couple different ways of determining that. Percentage of sales method, or POS, or the percentage of receivables method. We're going to focus on percentage of receivables. Don't worry about percentage of sales. Percentage of receivables says, look, at the end of the year, let's look at accounts receivable in total. Let's estimate how much of that we might not collect. And we'll set up that adjusting entry to make sure that's recorded. Just to emphasize why the direct write-off method is not good, I want to show you this example. Assume that December 31st, 2021, okay, we report total accounts receivable $100,000. of which 8,000 is from Mid or Light. Now, we find out within 10 days of the next fiscal year that that customer, Mid or Light, files for bankruptcy. That's bad news. That means if we're using the direct write-off method, once we get notification, we have to reduce the accounts receivable by the 8,000. So it doesn't quite show it right here, but we need to write in 8,000. Let's see if I can get this on here. Oh, this being a pain in the butt for me. Bad debt expense, right in the $8,000 right here in that block, right? 8,000, debit 8,000, credit 8,000 to accounts receivable. My computer is being a little bit pissy today. If we record the $8,000 write-off here, what that means is in the previous year, 2021, our accounts receivable was overstated by 8,000. We probably should have known this was going to happen. It means our expenses were understated by 8,000. It means that our net income was overstated by 8,000. We don't want to do this. The point I'm trying to make here is under the direct write-off method, you really run the risk of reporting information in a very overly optimistic way. And that's what investors hate, because when bad news happens, investors look to the company and say, why didn't you tell me this? Fine. Just understand, we record bad debt expense before it happens. If that helps understand, realize that there's a risk, and we want to make sure that the cost associated with the risk of not collecting is recorded in the right period. So, the allowance method requires us to predict, i.e. estimate through judgment, how much of accounts receivable we will not collect. In doing so, we figure out that we need to recognize NRV, net realizable value. Net realizable value is accounts receivable at the gross balance minus the allowance, whatever the balance is in the allowance account. That is net realizable value. That's some amount less than just total accounts receivable. How does it look? Well, assume that we made during the year, our first year of operations, we start off, all of our account balances are zero. We make sales on account throughout the period of about 1.8 million. At the end of the year, we still have 150,000 in accounts receivable we haven't yet collected. Fine. Should we do anything? Yes, we should. We should predict how much of the 150 we won't collect. Here we're saying 10,000, and this is information I would give you on the exam, 10,000 of the 150 we might not collect. What's the adjusting journal entry? Okay. Why don't we take a step back? Don't just look at the mechanics. Make sure you understand what's going on, because a lot of you guys out there, you don't quite understand or appreciate the theory. If we don't record anything, we run the risk of overstating our assets. Accounts receivable right now is 150. That's potentially too high. We don't want to overstate our assets. We want to report 140. In other words, we want to set up a contra account balance to offset the 150 to make it more of a realistic projection of how much we might collect. Remember, accounts receivable represents what we expect to collect. Right now, there is no allowance, and there's no expense there's no corresponding expense. Potentially, our net income would be too high if we just hit print on our income statement and on our balance sheet. Here's how the allowance method works. It quite literally goes like this. Make sure you put a star next to this slide. If we know the beginning balance, the current balance in the allowance account is a zero credit value, and the information of the problem says we need 10,000 credit balance in there, then the adjusting entry is this. Credit 10,000, debit bad debt expense 10,000. That is it. Practice this, folks. I cannot emphasize this enough. It's not overly complex if you just practice writing it out. When we record this thing, we still have our balance in accounts receivable 150, but we set up this contra account balance to offset the accounts receivable to net it to 140, or 150 minus the 10. We also show, so our balance sheet shows 140, but we also show a lower net income because we're including this 10,000 or 10, whatever it is, as an expense on our income statement. So our overall net income is going to be reduced by this expense. So we're avoiding we are avoiding the overstatement of net income, and we avoid the overstatement of our assets. Yes, it's just a prediction. So a lot of people say, well, what happens if there is a write-off or not a write-off, right? A write-off is quite literally when we get rid of an account receivable. We only write off accounts receivable when we get notification from bankruptcy court that our customer is not going to pay us. Just simply guessing that a customer won't pay us doesn't mean we have to reduce accounts receivable. If we guess that accounts receivable may not be collected, use the contra account. Do not record a reduction to accounts receivable. If you know that accounts receivable must be written off because bankruptcy court says they're not going to pay us, then we can actually write off the account. We can actually put in a credit to the account receivable and a debit to the allowance for bad debts. Remember, the allowance account is the contra account. In this case, we thought there was going to be 10 in total accounts receivable, maybe written off. 1 has actually come through. Therefore, when we actually reduce accounts receivable and the allowance account, we do not record bad debt expense. Why? Because we already recorded bad debt expense last year or last month, whenever it was. When an actual write-off happens, we just simply reduce the 2 balance sheet accounts. And when we do, and put a star next to this, you need to know this for the exam, net realizable value is still 140. It's not magical, it's mechanical. 149 is remaining in accounts receivable, and the 9 is remaining in the allowance account. That's nice, because when bad news does actually happen, we're not called out as liars. We already told investors, look, we expect to collect 140, and even when there is a write-off, we still show accounts receivable net realizable value of 140. That is the allowance method. A lot of people get confused by that. Don't let that be you. Now, this is kind of tedious. Assume Mitter comes back and says, hey, you know that 1,000 I promised not, I said I was not going to pay you. I actually have the money. I'm going to pay you that 1,000. That's a good thing. It's just a pain in the butt. So what we need to do is reverse the write-offs. First step, reverse the write-off we previously did on the other slide. Fine. I wrote you off before. I'm going to put it back in my accounts receivable. Now, pay me my money. Debit the cash when I get the cash. Sometimes I don't record this second journal entry. I don't record either journal entry until I get the cash. Because if they already told me, hey, I can't pay you, I might be very suspicious about their claims that they do promise to pay me. How do companies estimate bad debt expense? It's the percentage of receivables method I want you to worry about. Percentage of receivables says, look, either look at accounts receivable and use a percentage, multiply that percentage times accounts receivable. That's your allowance. A more appropriate way, and this is especially important for anybody who's going to start, you might become an auditor. The aging schedule, aging of receivables schedule is, or otherwise known as the AR, gives us a breakdown of how much money our customers owe us and how long those balances have been outstanding. So in this example here, when you're looking at the aging schedule, you'll see that Hilo Food Mart, they owe us a total of $320,000. 280 of that was a sale that happened within the past 30 days. 40,000 of that happened over a month ago, but still less than 2 months ago. Fortunately, Hilo doesn't have anything older than that, but look at Beach's Cafe. They owe us $55,000. But how long has that $55,000 been outstanding? For over 120 days. That's over 4 months. That's a big yikes. We may need to contact that person directly if we haven't already. But things that are current, I'm pretty confident I'm going to collect that stuff. When you're using this percentage methodology, you're really kind of looking at the aging schedule, the individual columns, and you're trying to apply a percentage to each individual column based on those columns' risk. So it's still a percentage methodology, but the aging schedule says there's 1% for those that are less than 30 days old, there's 1% for those outstanding balances that are about a month old, and so on and so forth. The balances that are fairly current have a low risk of being defaulted. Those balances that are really old those have a higher risk of being defaulted and therefore written off. So we're very suspicious about old outstanding balances. Therefore, when you look at this estimated percentage uncollectible, it represents what percentage of the total amount in the column might not be collected. So for that, what was it called? Beaches, the deadbeat beaches. Beaches, at that 55,000 right there, beaches, there's a 25% chance I might not collect 55,000. The 14,000 in the other column, there's a 20% chance I might not collect that. So you might kind of see where I'm going with this. Each column has its own risk of not being collected. So when it comes down to it, all you need to do is multiply each column's total by its individual percentage, then add them, all those amounts up. That is your total allowance account balance that you need to report at the end of the year. In other words, I may have 547,000 in accounts receivable, but I suspect that 26,610 will not be collected. You got to take a step back and draw this thing out. Do the homework. Make sure you know the process by which you do this. Also, by the way, too, if I tell you 26610 is what we need as the allowance balance, remember that it still requires us to look to see how much of an adjustment is required. If there's 0 in our allowance for bad debts and we need 26610, then yeah, we'll go ahead and the adjusting entry will be debit bad debt expense 26610, credit the allowance for bad debts for the same amount. But you've got to read the problem carefully. People miss this problem on the exam. If the allowance account already has, say, 6,610, and we need 26610, then the adjusting entry is only 20,000 in that case. We don't need to do the whole 26610. We just need to make sure that the balance in the contra account is 26610. And the balance is 28,000, and we only need 26610. Then we'll go ahead and debit the allowance account and credit bad debt expense. Now, I know that looks weird, and that's totally fine, but realize the adjusting entry quite literally is that. Adjusting entry means we're adjusting the contra asset account in this case. Bad debt expense is, yes, normally a debit, but it only the amount only represents the adjustment that's needed to the allowance account. In the third example here, if we need to reduce the allowance account, we have a weird looking credit balance in our bad debt expense. It doesn't happen very often, but hey, when it does, just go with it. Don't overthink bad debt expense. This whole process is quite literally figure out the plug figure.